Welcome to the Deep Dive. Today we're tackling, well, one of the most frustrating and, frankly, long-running economic puzzles out there. Japan's lost 30 years.
Yeah, it's this really puzzling period. Started back in the early 90s, continues pretty much today. Japan was, everyone agreed, a global industrial giant, right? Tech leader, huge export.
And then the engine just stalled.
Exactly. Stall. Its nominal GDP just flatlined. It's been stuck around that 500 trillion yen mark for decades now.
Even though, and this is the kicker, policymakers threw everything at it. Every single trick in the mainstream economic textbook.
They really did. Interest rates slashed to zero.
Yep. Quantitative easing, printing money.
Massive government spending on infrastructure, deregulation.
You name it, they tried it.
Yeah.
And it's this real-world paradox, isn't it? Textbook solutions just didn't produce textbook results. Zero.
Right. And the source material we're digging into today makes a pretty bold claim. It argues this whole stagnation wasn't, a failure of Japanese industry or its people. No, it argues it was a failure of the ideas being implemented, the economic theories themselves.
Okay, so the core argument is what? That the prescriptions were wrong because the economics were wrong.
That's the thesis. Misguided prescriptions written by wrong economics. So our mission in this deep dive is, well, it's pretty critical. We need to unpack how the two big schools of mainstream thought, Neoclassical and Keynesian, how they failed so spectacularly when put to the test in Japan.
And zero in on the root cause.
Exactly. We need to look closely at what the source identifies as the single fundamental theoretical mistake that led both schools down the wrong path. Their basic misunderstanding of what money actually is and how it works.
And this isn't just some academic exercise about Japan, is it?
Not at all. Think about it. Every time you, listening right now, hear debates about austerity versus stimulus or interest rates or government debt or inflation targets,
you're hearing these same theories in action.
Precisely. You're hearing echoes of these exact economic models. So understanding why they, frankly, crumbled under the weight of the Japanese data helps us understand the fundamental flaws that might still be influencing global policy right now, today.
Okay, so this has implications far beyond Japan. Let's get into it. Where do we start?
Right. Let's unpack this, starting with the ideology that really kicked things off, market fundamentalism.
Okay, so first things first. When we say mainstream economics, what are we actually talking about?
Generally, it stands on two main pillars, historically speaking. You've got neoclassical economics and Keynesian economics.
Neoclassical, that comes from the older classical school, right? Adam Smith, laissez-faire, the invisible hand.
Exactly. The idea that markets, if you just leave them alone, will find the best, most efficient outcome naturally.
But that idea took a massive hit during the Great Depression, didn't it?
Oh, absolutely. Lost pretty much all credibility. When markets globally just seized up, it was painfully obvious they weren't self-correcting.
So how did it survive?
Well, the source points out it didn't really die. It sort of retreated into academia and went through a transformation. It got very mathematical.
The math rescue.
Kind of, yeah. The big moment was the proof of general equilibrium by economists Kenneth Arrow and Gerard Debreu in 1954. This provided a super rigorous mathematical foundation.
And allowed those classical ideas to come back, but dressed up in complex equations.
Pretty much. That's what we now call neoclassical economics. And this mathematical core, it's still incredibly influential. It's the bedrock for a lot of macroeconomics today, especially in central banks, the IMF, places like that.
And that leads to models like DSGE.
Right. The Dynamic Stochastic General Equilibrium Model, DSGE.
Okay, DSGE sounds complicated.
It is. But basically, it's a big computer model trying to simulate the whole economy. It uses micro-foundations, how individual households and firms are expected to behave rationally, and then tries to predict how they'll react to different economic shocks, like a change in interest rates or oil prices.
But here's the first major problem the sources highlight, right? The assumptions you need to make that model work.
Oh, they're heroic. Completely detached from reality.
Like what?
Well, for that general equilibrium math to hold, the world inside the DSGE model has to be, well, a fiction. You have to assume all markets are perfectly competitive.
No monopolies, no big players with market power?
None. Prices have to be perfectly flexible, adjusting instantly to any little shift in supply or demand. Information has to be perfect and complete for everyone, all the time.
Which is obviously not true.
Obviously. And the biggest one. Everyone, consumers, businesses, has to be a perfectly rational maximizer, always making the absolute optimal choice to maximize their utility or profit without any emotion, bias, or, human error.
So it's a model of an economy run by Vulcans, basically.
Pretty much. The moment you introduce real-world stuff, anxiety, imperfect information, dominant companies, prices that take time to change, the whole elegant mathematical structure just falls apart.
It proves how an economy would work if it followed these perfect rules, not how it does work.
Exactly. That's why the source material calls it a big fiction. But the key point is, this fiction isn't harmless when it gets translated into actual policy recommendations.
It becomes an ideology. Market fundamentalism.
That's the term they use.
Yeah.
And the approach is fundamentally deductive. It doesn't start by looking at how the economy actually works and deriving policy from that.
No, it starts with the theory.
Right. It starts with this pure theoretical ideal of general equilibrium, and then it tries to reform the real messy economy, what they call the supply side, to make it look more like the unrealistic assumptions of the model.
That's structural reform.
That's structural reform in a nutshell. It almost becomes like a doctrine, you know? The main goal is often just tearing down existing structures, labor laws, banking regulations, traditional ways of doing business, anything that seems to get in the way of that perfect free competition ideal.
No growth without structural reform. That's the slogan.
You hear it all the time. And the sources make a really pointed critique here. They argue this ideology wasn't just some academic fad. It was actively pushed and supported by powerful international financial interests.
Why? What was in it for them?
Well, think about it. If you promote free competition everywhere else in manufacturing, in labor markets you drive down costs and weaken established players. But at the same time, if you can deregulate finance,
You position yourself to control the money supply and the financial system with less competition.
precisely. You advocate for free markets for others while seeking monopolistic control over finance. It allows big financial players to operate sort of above the fray, extracting profits from riskier activities that deregulation enables.
And a prime example they point to in the U.S. context was the repeal of Glass-Steagall.
Absolutely. That was the Depression-era law that for decades kept commercial banking taking deposits, making regular loans strictly separate from the riskier world of investment banking and securities trading.
Kept things stable.
It did, largely, but when it was repealed in 1999, it broke down those walls. It let huge banks use customer deposits to fuel high-stakes gambling in things like mortgage-backed securities, complex derivatives.
Leading directly to the 2008 crisis.
The sources argue, yes, it was a major contributing factor. It unleashed the risk-taking that led to the subprime meltdown and the Lehman shock, which they actually call the Second Great Depression, a spectacular crash of that market fundamentalist ideology.
And Japan, meanwhile, got caught up in this same wave of thinking.
Completely. After its own bubble burst in the early 90s, the reforms Japan adopted were straight out of this playbook. Deregulation, privatization of major state assets like the post office and telecoms, making the Bank of Japan more independent.
All standard Washington consensus prescriptions.
Textbook Washington consensus. The assumption driving policy was that Japan's slump had to be a supply-side problem.
What did they blame specifically?
The narrative was low productivity, a rigid labor market where it was too hard to hire and fire people, and too many zombie companies being kept alive by banks instead of being allowed to fail.
So the solution was obvious, according to this view. More deregulation, break up old structures, force competition.
Tear it down to build it back, according to the model. But let's look at the counter-argument from the source, because it uses Japan's own data to tell a very different story.
Okay, what's the alternative explanation?
They argue the real problem, the cause of the stagnation, wasn't on the supply side at all. It was a collapse in demand.
Demand. How so?
Well, look at the data. During the initial years of the stagnation, Japan's population and labor force were actually stable, even growing slightly. But consumption per person started falling.
Why were people spending less?
The source argues it was a direct result of the structural reforms themselves. Policies that encouraged companies to cut costs by shifting to cheaper, non-regular temporary workers led to wage stagnation for the average person.
So less job security, stagnant wages.
Exactly. It created widespread anxiety about the future. People stopped spending, started saving more, or focused on paying down debt. Demand dried up.
So the irony is, the very policies meant to unleash growth by boosting supply actually ended up crushing the demand needed to buy that supply.
That's the argument. And it undermines the whole supply-side deficiency narrative.
What about the idea that Japan's structures were just inherently inefficient?
The source pushes back hard on that, too. Just look at the 70s and 80s. Japanese companies achieved incredible growth, dominated global markets.
They're using the exact same structures, lifetime employment, karetsu relationships, main bank system that the reformers later wanted to dismantle.
Right. The system clearly worked incredibly well before the bubble burst and the reforms began. It wasn't inherently broken.
Okay, but what about the argument we still hear constantly? Demographics. Japan's population is aging. Surely that's the main reason.
The timeline just doesn't fit, according to the source. The deep recession started in the early 1990s.
And Japan's population didn't start shrinking until
2011, 2 decades later. The labor force was stable through the 90s. There wasn't some sudden physical shortage of workers or capital back then.
So the job losses that did happen later.
They argued those were a result of falling production demand, not the cause of the stagnation. It points back to demand, again.
So the verdict on this neoclassical market fundamentalist approach in Japan seems pretty clear from this perspective.
Yeah, the source concludes it was an unambiguous failure. The policies didn't deliver growth, they didn't raise wages, and arguably they made things worse by hurting demand and dismantling a previously successful model. By 2008, with the Lehman shock, the source says the failure of this ideology was simply irrefutable.
Okay, so if market fundamentalism failed, the next logical place policymakers turn is Keynesian economics.
Right. The other major pillar, often called the aggregate demand management approach.
And this starts from the opposite premise, that markets aren't self-correcting.
Exactly. Keynesianism was born from the Great Depression, the realization that economies can get stuck in deep, prolonged slumps if left alone. So the government has to intervene.
Using what tools?
Fiscal policy, government spending, and taxation, and monetary policy, interest rates, and money supply to actively manage overall demand and steer the economy back towards full employment.
This became the standard operating procedure for decades, right?
Absolutely. Post-war boom, this was the dominant framework globally. But, and this is the absolute crucial point the source hammers home, its application in Japan also failed. And it failed because of a single critical theoretical flaw.
Just
The assumption that money is exogenously supplied.
Okay, stop there. This sounds really important. Let's spend a minute on this distinction, because you said it's the linchpin of the whole argument. What does exogenous money mean in practice?
If you believe money is exogenous, you think money comes from outside the normal workings of the private economy. Specifically, it's supplied by the central bank.
Like the Fed or the Bank of Japan controls a tap, and they decide how much money flows into the system.
That's the mental model, basically. The central bank directly controls the quantity of money circulating, what economists call M1. Policymakers turn the faucet up or down.
Okay, that's the standard textbook view. What's the alternative theory the source puts forward?
The alternative is the theory of endogenous debt money.
Endogenous, meaning created from within.
Exactly. This theory says the money stock isn't supplied from outside, it's generated from inside the private economy. And specifically, it's created whenever a commercial bank makes a loan.
Wait, so when I get a mortgage, the bank isn't lending me someone else's savings?
No. According to this theory, the bank literally creates new deposit money in your account at the moment the loan is issued. Poof. New money exists that didn't exist before. The loan creates the deposit.
That's a radically different way of thinking about it.
It fundamentally changes the picture. It means that in our current financial system, the economy literally cannot function or grow unless somebody, households, firms, or the government, is willing to go further into debt.
Because borrowing is money creation. Money is debt.
That's the core idea. Money must be someone's liability, which explains why borrowing is so central to the whole system.
Okay, so why do these different sectors borrow? Let's break that down. Households.
Usually for big-ticket items, right? Things that cost way more than you earn in a month or have saved up. Buying a car, buying a house, paying for university tuition. These major life events require debt, and that debt creates new money.
Okay. What about businesses, firms?
For producers, it's a bit more systemic within capitalism. Modern corporate rules often pressure companies to distribute profits back to shareholders.
Through dividends or stock buybacks.
Right. Which means even if a company is profitable, it often can't just stockpile huge amounts of cash internally for future big investments.
So they have to go outside to raise funds.
Exactly. They're often obliged to raise funds externally by borrowing from banks, issuing corporate bonds, or selling new shares. They essentially have to borrow back the money they just paid out. It's a continuous cycle. Corporate borrowing is vital for investment and keeps injecting new money.
And finally, the government.
Government borrowing funds, public services, big infrastructure projects, unexpected costs like disaster relief, and increasingly things like Social Security and healthcare as populations age.
So all three households, firms, government borrowing is the engine creating money in this endogenous view.
That's the mechanism, but the standard Keynesian model kind of misses this because it starts with that exogenous assumption that the central bank is the ultimate source of money.
Right. So how does that faulty assumption mess up the Keynesian framework? Let's talk about their theory of income determination and this idea of the GDP gap.
Okay, this is basic macroeconomics 101. The starting point is the national income identity. You see it everywhere. GDP, consumption plus investment plus government spending plus net exports. That's just an accounting fact. From that, you can derive another identity. Savings must equal investment plus the government deficit, SI plus GT.
Got it.
Now, under the exogenous money view, this leads to the concept of the GDP gap, or the IS balance. That's the difference between how much the economy is saving and how much it's investing.
And the worry is if savings are higher than investment.
Yeah, the conventional Keynesian story is if people and firms are saving more money than is being put back into the economy through investment spending, then money is leaking out of the circular flow.
Leading to.
Not enough demand. Businesses can't sell all their stuff. Production falls. People lose jobs. You get a recession.
So the whole point of Keynesian policy is to close that gap.
Exactly. Use monetary policy, lower interest rates, to encourage more investment, or use fiscal policy, government deficit spending, to directly inject demand and fill that hole, getting savings and investment back into balance at full employment.
But if the source is right and money is endogenous, does that GDP gap even exist in the same way?
That's the crux of it. If money is created by borrowing, the whole concept of a gap between savings and investment becomes questionable. The source argues the entire idea relies on that flawed exogenous money assumption.
And that flawed assumption sets the stage for the policy failures we saw in Japan.
Precisely. It leads directly into the monetary policy mess.
Okay, so Japan in the 90s, they see what looks like a massive GDP gap. Savings are high, investment is sluggish. The first Keynesian tool is traditional monetary policy.
Right. Lower the interest rates, make it cheaper to borrow, encourage businesses to invest, get household spending, close that gap.
How does the central bank, the Bank of Japan, BOJ, do that?
Well, the textbook says they increase the supply of base money, M0, the reserves commercial banks hold. By flooding the banks with reserves, they push down the overnight lending rate between banks, and the idea is that lower cost of funds will ripple through the system, lowering borrowing costs for everyone and eventually boosting M1, the actual money people use.
That's the theory, the standard ISLM model logic.
That's the theory. Now let's contrast that with what Japan actually did, particularly on the fiscal side, which complicates the monetary picture.
They spent huge amounts.
Gargantuan amounts. Over those 3 decades, the Japanese government issued about 595 trillion yen in government bonds, JGBs. That averages out to roughly 20 trillion yen in new government borrowing every single year for 30 years.
Wow. Okay, the moment a mainstream economist hears that number, massive government borrowing, what theory immediately pops into their head?
Crowding out, absolutely.
Explain that.
Crowding out theory is built directly on that exogenous money idea that there's a limited pool of savings and loanable funds out there. So if the government comes along and starts borrowing enormous sums,
It sucks up all the available money.
exactly, it competes with private borrowers for those scarce funds, pushing up the demand for money. The prediction is clear. Interest rates should skyrocket and the price of existing bonds should plummet. That's what should happen when government borrowing gets that big, according to the standard model.
But what actually happened to Japanese interest rates?
The complete opposite. It's one of the starkest empirical refutations of a mainstream theory you could find. Japanese 10-year government bond yields didn't rise, they collapsed.
Collapsed?
Plummeted. They were already below 1% by 2002. And then, incredibly, in 2016, they even briefly went negative.
Negative. People were paying the Japanese government to hold its debt.
Effectively, yes. For the privilege and safety of holding JGBs, this is the absolute opposite of what crowding out predicts.
Okay, that is a genuine mystery then. How can massive government borrowing lead to collapsing interest rates? The theory says it should be the other way around.
It's a mystery if you assume money is exogenous.
So this is where the endogenous money theory provides an answer.
Exactly. The mystery dissolves once you accept that money is created by debt. The government's huge bond issuance wasn't crowding out private funds from a limited pool.
It was creating the money supply itself.
Precisely. Think about the mechanism. The government issues JGBs to fund its spending. Now, who buys those JGBs, especially when rates are so low? Increasingly, it had to be the Bank of Japan itself through quantitative easing.
Okay.
When the BOJ buys a JGB from a commercial bank, it credits that bank's reserve account at the BOJ. That injects M0, high-powered money, into the banking system. This increase in reserves facilitates the overall growth of M1 as the government spends the borrowed money and it circulates.
So the chain of causation is completely flipped.
Totally flipped from the textbook story. It wasn't. Government debt competition for funds, higher rates. It was. Fiscal stimulus, debt issuance, BOJ bond purchases, QE, massive increase in M1 money supply, glut of money, falling interest rates.
More supply of money lowers the price of money, which is the interest rate.
Exactly. Simple supply and demand in the money market once you understand where the supply actually came from.
Is there data to back this up?
The source provides pretty compelling statistical evidence. Regression analysis showed that the 595 trillion yen increase in government debt directly accounted for something like 669 trillion yen of the total increase in M1 over that period.
Wait, the government debt caused more than its own value in M1 growth?
Well, it accounted for the vast majority of the increase. It suggests 91.5% of the rise in the circulating money stock came directly from government borrowing being monetized.
So crowding out theory just didn't apply.
It was based on a fundamentally wrong premise about how money works, a premise that just failed the empirical test in Japan.
Okay, so the BOJ succeeded in crushing interest rates, reaching the zero interest rate policy, or ZIRP, by 1999. But they still hit a wall, didn't they? The famous liquidity trap.
Yes. Even with interest rates at zero or effectively zero, the intended Keynesian effect stimulating private investment and consumption didn't happen.
Why not? Money was practically free.
Because the private sector businesses and households weren't responding to the price of money, they were responding to something else entirely, their own balance sheets.
Meaning?
The bursting of the bubble in the early 90s left companies and families drowning in debt. Their overwhelming priority wasn't taking out new cheap loans, it was paying down the old expensive ones. It was about deleveraging, repairing their balance sheets.
So they were more sensitive to their level of debt, their solvency, than to the interest rate.
Exactly. They needed to reduce liabilities, not add more, no matter how low the rate was. Add to that a general sense of anxiety about the future, deflationary expectations.
People just weren't borrowing or spending.
Right. You can lead a horse to water, but you can't make it drink. You can offer 0% loans, but if everyone is focused on saving and paying down debt, that monetary policy lever is essentially broken. It becomes ineffective.
So the traditional policy failed because the real-world actors weren't behaving like the rational maximizers of the neoclassical models, or even the simple interest rate-sensitive borrowers of the basic Keynesian models.
They were acting like humans scarred by a massive asset bubble collapse. The liquidity trap showed the limits of conventional monetary policy.
Which forced the BOJ to move into even more unconventional territory.
Yes. With rates at zero, they had to try something else. Massive quantitative easing, or QE. The reflation strategy.
Okay, so traditional monetary policy is out of ammo because rates are at zero. The BOJ turns to quantitative easing, QE. What exactly were they trying to achieve with
Well,
that?
QE involves the central bank buying up huge quantities of assets in Japan's case, mostly those JGBs we talked about, but also other things later on. The immediate effect is to pump M0, base money or bank reserves, into the system on an unprecedented scale.
But if interest rates are already zero, how does adding more reserves help?
This is where the logic gets a bit more sophisticated. It's based on ideas going back to the economist Irving Fisher in the 1930s, and it's all about managing expectations.
Expectations.
Yeah. The theory goes like this. If the central bank commits credibly to an inflation target, say 2%, which the BOJ eventually did, and simultaneously floods the system with money via QE, hoping to boost M1.
People should start to expect prices to rise in the future.
That's the goal. And here's the clever part. If the nominal interest rate is stuck at zero, but people start expecting 2% inflation, what happens to the real interest rate?
The real rate is nominal minus expected inflation. so it becomes negative, -2%.
Exactly. A negative real interest rate means the real value, the purchasing power of debt is actually shrinking over time. So theoretically, this should give everyone a massive incentive to borrow and spend now before prices go up and while the real cost of borrowing is negative.
It's trying to jolt the economy out of the trap by changing psychology.
Precisely. Manipulate expectations to force action. It's quite ingenious on paper.
And the source mentions a historical irony here.
Yeah, it's fascinating. Irving Fisher himself proposed this exact reflation through expectations policy back in 1932-33 to fight the Great Depression. But the source notes he quite quickly realized its limitations under a debt money system and abandoned it, eventually advocating for a radical 100% money reform instead.
But the BOJ went ahead with it anyway. Massive QE programs.
They did. 3 huge rounds of QE. But for this whole strategy to work, for QE to translate into expected inflation and negative real rates, it relies entirely on the underlying quantity theory of money framework. M times V equals P times T.
Money supply times velocity equals the price level times transactions, or GDP.
Right. And for policy purposes, for the BOJ to control P and T by manipulating M, 2 critical assumptions have to hold true in the real world.
What are they?
First, you need a stable or at least predictable money multiplier, M. And second, you need a stable or predictable velocity of money, V.
Okay, let's take those one by one. The money multiplier, M, what happened to that in Japan?
It completely collapsed. Remember, the multiplier is the link between the base money the BOJ controls, M0, and the broader money supply circulating in the economy, M1. M1 equals MM0. If M is stable, controlling M0 lets you control M1.
But it wasn't stable.
Not even close. The data shows it was reasonably stable before the crisis, peaking around 3.89 in 1998. But once the crisis hit, and especially when QE ramped up, M started fluctuating wildly and then just plunged. It fell all the way to 1.72 by 2019.
So what does that mean in simple terms? A falling multiplier.
It means the BOJ was pumping huge amounts of M0 into the banks, but the banks weren't multiplying it up by lending it out. The private sector wasn't borrowing. The connection was broken.
The plumbing was clogged, like you said before.
Exactly. The BOJ could push on the M0 lever all it wanted, but M1 just wasn't responding predictably. They lost control over the broader money supply. So premise number 1 for reflation failed.
Okay, what about the second premise? The velocity of money, V.
Same story, unfortunately. Velocity V is just how quickly money changes hands, how often each yen is spent and respent to generate GDP in a given year.
And if velocity is stable, then changes in the money supply, M1, should translate directly into changes in nominal GDP.
That's the idea. If M1 grows by 5% and V is constant, nominal GDP should grow by 5%. The BOJ was hoping for maybe 2% inflation and 3% real growth, T.
But what happened to velocity in Japan?
It tanked, just like the multiplier. After the bubble burst in 91, velocity started a steep, relentless decline. It fell from over 3 down to less than 1 by 2019.
Less than 1? What does that even mean?
It means the average yen was being spent less than once per year to generate nominal GDP. The money stock was growing, thanks mainly to government debt, but it just wasn't circulating.
It was being hoarded or used to pay down debt.
Seems like it. The falling velocity completely absorbed the impact of the M1 increase. The BOJ was pouring fuel M1 into the engine, but the engine itself, velocity, was seizing up. Money almost stopped moving.
Which is why the economy felt so stuck, so stagnant, despite all the money printing.
Precisely. So premise number 2 for reflation also failed spectacularly.
Now, the source argues there's a deeper theoretical mistake here, right? Something about confusing an identity with an equation.
Yes, this is a really crucial point about the quantity theory, MV equal PT. Mathematically, it's always true by definition. It's an identity. The amount of money times how fast it's spent must equal the value of transactions.
Okay.
But the monetarists, the ones pushing reflation, turn this identity into a policy equation. They assumed they could actively control M, the money supply, and because they assumed V was stable, they could therefore dictate the outcome for PT, nominal GDP.
They thought M causes P and T.
Essentially, yes. They got the causality backwards.
How so?
Under the endogenous money view, the money supply, M, doesn't determine economic activity. It's the other way around. Economic activity, people and businesses deciding to borrow and transact, generates the money supply. M is created by T.
So if economic activity and borrowing are stagnant,
then M will be stagnant, or its velocity will fall, regardless of how much base money M0, the central bank, creates. The BOJ was, as the saying goes, pushing on a string.
and the data confirms this lack of causal power.
Overwhelmingly. The source cites regression analyses showing almost no correlation between GDP and M0, a coefficient below 0.09, and only slightly better, but still incredibly weak, for M1 around 0.046. Meaning increases in base money, M0 barely translated into GDP growth at all, maybe 9 cents on the dollar, and even the broader money supply, M1, only contributed about 5 cents on the dollar to GDP. The impact was trivial.
So the whole careflation strategy was fundamentally flawed because its core assumptions about the money multiplier and velocity were empirically wrong.
And those assumptions were wrong because the underlying theory misunderstood the endogenous nature of money creation in a debt-based system. It was trying to fix a crisis of debt and demand by manipulating a variable, M0, that had lost its traction.
Okay, so traditional monetary policy failed. Radical QE-based monetary policy failed. What's left in the standard Keynesian toolkit?
Fiscal policy. If the private sector won't spend and monetary policy isn't working, the government has to step in directly.
By running bigger deficits.
Yes. Increase government spending or cut taxes, finance it by issuing bonds, and directly inject demand into the economy to fill that perceived GDP gap. This is the core logic behind anti-austerity arguments we hear everywhere.
But here we need to circle back again to that fundamental issue. The GDP gap itself and the exogenous money assumption it relies on.
Exactly. Because if we accept the endogenous money framework, the source argues the whole way we think about savings and investment needs to be flipped.
How so? Remind us.
In the standard view, savings need to be channeled into investment. If savings exceed investment, there's a gap. But in the endogenous money view, it's the other way around. Investment decisions come first. Businesses decide to invest, they borrow money into existence to do so, and this investment spending creates the income elsewhere in the economy, which then allows savings to happen.
So investment generates its own savings.
Ex post, yes. After the fact, savings will always equal investment, plus the government deficit, if any. It's an accounting identity that holds true because investment creates the funds that are then saved.
Okay, if investment automatically generates savings, what does that imply for the concept of a GDP gap?
It implies there's no such thing as a systemic gap where savings are leaking out and need to be plugged by the government. The idea of a gap is an artifact of the incorrect exogenous money view.
Wow. If the gap doesn't exist in that way, then fiscal policy designed specifically to fill that gap
is based on a false premise. It's targeting a problem that isn't the real problem. The source argues fiscal policy's role shouldn't be to fill a non-existent gap, but maybe to support or incentivize private investment, which is the real engine. It shouldn't be the primary driver itself.
Yet Japan went all in on fiscal stimulus, racking up that incredible 595 trillion yen debt pile. So the crucial empirical question is, how effective was all that government borrowing compared to private borrowing?
This is where the source's analysis gets really damning. They ran multivariate regressions using data from 1980 to 2019 to isolate the impact of changes in private debt versus changes in government debt on GDP growth.
And the results. Let's start with private debt borrowing by companies and households.
The correlation between private debt changes and GDP changes was extremely strong, almost perfect, at 0.9389.
And the impact factor. How much GDP did each yen of private borrowing generate?
The regression showed that a change in private debt caused GDP to change by 49% of that amount. So roughly, for every yen borrowed by the private sector, GDP went up by about half a yen.
Okay, 49 cents on the dollar for private debt. That confirms the earlier point. The collapse in private borrowing after 1990 was a huge drag on growth.
Absolutely. Now compare that to government debt.
Correlation.
Much weaker, still positive, but only 0.6159.
And the crucial impact coefficient. How much GDP from government borrowing?
Only 11%. Just 11 cents on the dollar.
Wait, 49% for private debt, but only 11% for government debt.
That's what the empirical analysis showed for Japan over that period. Government borrowing was roughly 1/5 as effective at stimulating GDP as private sector borrowing was.
That is staggeringly inefficient.
It really is. The main policy lever Japan pulled for decades was working, but with incredibly low efficiency compared to the private sector activity it was trying to replace.
And this finding just blows up the standard textbook idea of the fiscal multiplier, doesn't it?
Completely demolishes it. You know, textbooks often talk about multipliers of 2 or 3, suggesting that 10 trillion yen in government stimulus should generate 20 or 30 trillion in sustained GDP growth.
Yeah, that's the theory.
But the source argues that multiplier effect is often temporary. unless the government spending genuinely triggers a sustained wave of follow-on private sector demand and investment, which it clearly didn't in Japan.
They spent $20 trillion a year for 30 years. If the multiplier was 3, GDP should have been way higher.
Exactly. It should have been astronomically higher. The reality didn't match the theory at all.
So can we use those empirically derived coefficients, the 49% for private, 11% for government, to see what actually happened during a specific period, say the core stagnation years?
Yes, the source does this calculation for 1995 to 2012. Over that time, private debt decreased by 125 trillion yen as companies and households paid down loans.
Okay, using the 49% factor, that deleveraging should have reduced GDP by
about 61 trillion yen, 125, 0.49. That was the headwind the economy faced from the private sector cleaning up its balance sheet.
Okay. And during that same period, the government stepped in. How much did government debt increase?
It increased by a massive 383 trillion yen.
And using the much weaker 11% impact factor, that should have increased GDP by
only about 42 trillion yen, 383.11.
So let me get this straight. Private sector deleveraging subtracted 61 trillion from GDP. Massive government borrowing added back only 42 trillion.
That's the net result based on the analysis. The total change should have been a decrease of 19 trillion yen, 42 minus 61.
And what was the actual change in GDP over that period?
The actual decrease was 26 trillion yen. Pretty close, suggesting the model captures the dynamics well.
That is incredible. It means the hundreds of trillions in government borrowing didn't actually drive a recovery.
No. It essentially just served to offset most of the GDP loss caused by the private sector paying down its debt. It was a huge, inefficient compensatory action, not a growth engine.
But hang on, couldn't you argue that offsetting that massive private drag was important? Without that 11% boost, wouldn't Japan have faced an even deeper collapse, maybe validating the Keynesian approach as a necessary, albeit inefficient, stabilizer?
That's a fair point, and the analysis doesn't deny that. The fiscal spending almost certainly prevented a complete catastrophic meltdown, a true second Great Depression scenario triggered by the 61 trillion private sector drag. So yes, it acted as a massive inefficient subsidy or stabilizer.
Okay.
However, the crucial distinction is that the policy wasn't sold or intended merely as a damage control measure. It was promoted politically and economically as the path back to strong, sustainable growth. And in that goal, achieving actual recovery and growth, the source concludes it failed completely.
And the cost was immense, that huge pile of government debt.
Exactly. So the conclusion is stark. Fiscal policy, operating under the flawed premise of filling a non-existent GDP gap derived from an incorrect theory of money, proved equally ineffective as monetary policy in generating real growth. Both major schools of mainstream economics failed the Japanese test.
Because both were fundamentally based on a wrong understanding of how money is actually created and circulated in a modern economy.
That's the core argument. They were using the wrong map, trying to fix a debt crisis with more, less efficient debt, guided by theories that didn't match the reality of endogenous money. #tag outro.
So bringing this all together, the experience of Japan over these lost 30 years serves as a powerful real-world case study.
The source calls it the final testament, really, to the failure of both mainstream approaches when pushed to their limits. Neoclassical market fundamentalism.
Its structural reforms arguably damaged the demand side.
And Keynesian aggregate demand management.
While maybe preventing utter collapse, proved incredibly inefficient for driving growth. Because its tools, monetary and fiscal policy, were based on flawed concepts like exogenous money, the GDP gap, and stable multipliers that just didn't hold up empirically.
Right. Both failed because they started from that fundamental misunderstanding, assuming money is supplied from the outside, when the reality of our system is that it's generated endogenously from within, primarily through the creation of debt.
So where does that leave us? What's the path forward, according to this analysis?
Well, the authors conclude that Japan, and by extension, the rest of the world operating under similar financial systems, needs to break free from what they called the brainwashing of mainstream economics.
And develop an alternative.
Yes. Establish a new economic framework. They hint towards ideas like public money or sovereign money theory systems designed explicitly around the reality of endogenous debt creation, trying to manage it more directly and effectively. The solution isn't just fiddling with interest rates or deficit sizes within the current flawed model. It's potentially rethinking the mechanism of money creation itself.
That's a radical thought. It really shifts the focus.
It does, and it leaves us with a pretty challenging question, especially when you consider the current global situation.
Which is?
We've seen that our current system fundamentally relies on continuous debt expansion by households, firms, or governments just to keep money circulating and maintain nominal GDP. We've also seen the evidence from Japan suggesting private debt is maybe 5 times more effective at generating GDP than government debt. So, the provocative thought for you, the listener, is this. If economic stability requires perpetual debt growth, what happens to the global economy when the most efficient borrowers, the private sector, consumers and corporations become too worried, too saturated with existing debt, or just too risk-averse to keep borrowing at the necessary rate?
Can government borrowing, which seems far less efficient based on this analysis, really pick up all the slack indefinitely?
How long can any economy or the global system truly sustain itself by relying on policies that, when you look closely at the underlying mechanics of money, might only be delivering something like 11 cents of growth for every dollar borrowed by the public sector? What happens when that bill comes due for future generations?
That's definitely something to think about. Thank you for that deep dive.
Thank you.
Join us next time for another deep dive.